want to show you how to trade in forex. So this is a forex tutorial for beginners. So let's start. So we are going to learn how to beat the market like a pro with the trading game. So before you invest in something, invest time to understand it. In short, Warren Buffett. His net worth was worth $79 billion. So about this ebook, we are going to learn about forex trading, the best brokers in the current regime, and we know mostly why people love forex. For example, now when you start with the $100, you may end up getting some good profit. So there is no crisis in market. Nobody can take control of your trade except you. But now you have what we call volatilities and market diversions. So you may be trading and get losses. At the same time, you may trade and get profits. So now let's start. So work while lying in our hammock. So when we mean you can literally trade markets while sipping on a cool drink and lying in a hammock. All you need to get started is some capital to trade with. So you need capital, you need a computer or laptop or a smartphone, an internet connection, and you decide when you want to trade, and therefore your working hours. So those will be your working hours. So no crisis. Even during a financial crisis, you can still make money trading forex market. Any oscillation in the currency may be taken advantage of by doing long or going short. So whether market is bullish, that is up, or bearish, that is downwards, you can trade either way with forex, unlike stocks or other financial instruments. So learn from pros with social trading. You can watch what professional traders are doing and to observe their trade with social trading. So that is what we call social trading. For example, now someone like me who knows how to trade, you may copy or ask him what he or she is doing. Then we have some easy rules in forex. The forex market is quite straightforward as compared to other financial markets. With the stocks, you have to analyze company reports and choose from thousands of companies to invest in. However, forex market generally revolve around 8 currencies known as the major. But simply, the better a country's economy is doing, the better we expect the economy to perform. So the way the economy, for example, the economy of a country like America is a developed country, so we expect in most of the time dollar will be stronger. So now let's continue how to trade if you are a busy person. So if you are busy during the day, or maybe you work at night, so you have to make your own schedule of trading. So if you are too busy to follow the news and monitor the charts of the day, it is possible to participate in forex trading in easier and less time-consuming way. Social trading allows you to connect with experienced traders, see their performance statistics, you discuss their trading ideas, you learn from their mistakes and copy their successful strategies. So we have what we call what? Copy trading. In most brokers, we have those passwords. You give it to your account, then the trades of the experienced trader will be copied to your account. So now, first thing, you choose a platform. Even if you are new to forex, there are friendly platforms with more than 10 million users that offer you an interesting opportunity to follow the best traders and copy their trades. So, first thing is to choose a platform. Second thing, you follow up trader. Discover traders you want to follow and add to your watch list. View their performance stats. Read status update on their strategies. Analyze results and communicate with them. Then the third thing is you copy their trades. If you are satisfied with the results and the trading style, you can copy their trades with one click of a button. Then the fourth thing is you learn and profit. Now you can sit back and watch experienced traders do the work for you. Your task is to carefully analyze their results and learn as much as possible from their trades. The ultimate goal of social trading is to build a portfolio of their best traders. You must have traders with different risk appetite and various currency. Then check out the most copied trader in that one. When you click it, you will see. Then now, let's learn what is leverage, PIP and spread. So, leverage, which represents a margin trading ratio, enables traders to borrow a certain amount of money that allows them to trade in their big deals. Moreover, leverage allows one to trade using more money than they have in their account. Therefore, you leverage your account balance to place a bigger trade. Currency rates move very slow. So, this makes more trades unfashionable. It only returns more profits and losses from PIP that changes. Therefore, leveraging helps one to trade in large deals, hence amplifying their potential losses. So, according to ESMA, intervention measure, leverage rates can only be offered between a margin of 2:1 and the ratio of that is to 1, depending on the specific instruments. So, leverage will allow you to trade with more capital than what you have. Hope you understand that. Then the second thing is a PIP. So this is what? The price interest. That is the point to represent the small change in a currency pair. Typically, it is the 40 decimal place. Although many brokers quote using the 50 decimal. However, their decimal doesn't really affect the price if it changes really quick. So currency pair that include US dollar, a PIP of 1/10,000 of a dollar Whereas when the currency pair includes the yen, a pip is 1 over 100 over yen, because the yen is closer in value to 1 over 100 of their major currency. So you can see this is a Euro USD pair, 1.2302 pip or point. So that point now, the difference between the price of the euro and the USD dollar, that's a pip. That's 1 pip. So now in the market, when the graph will start moving, it will be calling 1 pip, 2 pips, going that way. So that is the one which will make you get profit in case you're predicting the right direction. So now let's go to what we call spread. In forex trading, brokers quote the buy and ask price for the currency pairs. So they buy in the price that a trader can send the money, all the currency, while the ask price they can buy the base currency. So now we have the asking and the binding price. So spread refers to the difference between the two prices. So beside this, how the commission, brokers who do not change separate fee on traders. So this spread will make the brokers now, or in short, what I mean by brokers, they are the people who offer you the financial access to the market. So now when you will open an account, you will use a broker to access the market. So the broker must benefit from you. So, and the profit is hidden. So whether you make profit or you make loss, they will still have something in their pocket. So it's hidden. So what you see, the profit you see with your eyes in the trading app, that is what is your profit, all what is your loss. So they don't interfere with it. I say this because most of the people have misconception that brokers take your money. No, they don't take your money. So the spread is measured in pips. So most currency pairs, the base currency and the quote price have a pip where the value is 0.001. For instance, take the following. So now you can see here we have the Euro USD. This one, the Euro USD. Then we have 1.1051 over 1.1053. So the spread will be 0.002. So that is what they will take now, which equals to 2 pips. So that is what they will benefit from your trade, and it's hidden. You can't see it. So now let's learn now what is forex and find out here what it is. So in the forex market, we have over $5.3 trillion which are traded daily in the largest, and it is the largest market and the most liquid market in the world. So the trade in forex occurs between two currencies, as I have explained earlier. For example, we have the euro and the USD. So that is what we call currency pair. Two currencies combined. It's called currency pair. And we will use this pair, euro USD, to show you what we have explained earlier. So now you can see here clearly. Let me zoom. You can see there. We have the selling price. This is the selling price, and we have the buying price. So selling price is what you call buying price, and the buying price is what we call the asking price. So the difference between the selling price or the buying price and the buying price, that's where we come to get the spread of the market. Then the difference between the two is what we call a pip or points. So the smaller the spread, the more liquid the currency. Hope now you understand that. So we have that point of pip. The fourth unit after the decimal point, which is the smallest unit of the exchange rate. Then the spread is the difference between the sell quote and the buy quote in pips. So now, how to read the currency pair. So now, the currencies are traded in pairs and their value is relative to one another. So the currencies have different what values. So now the currency shown below, that is they are in terms of order. So now the first currency which appears on your left side is called the base currency. And in this case the base currency is the what? The euro. Then on your right hand we have what we call quote currency. So in this case the quote currency is the United States dollar. And you can see in the picture, let me zoom on, you can see it clearly. So now 1 euro is worth $1.1302. So that is the comparison now. So I hope you understand that. So we trade one currency against the other. So we have to buy or sell the first currency against the second currency. So now we have the major currencies like the euro currency pairs, Euro USD, GBP, that is the Great Britain pound against USD dollar. Then you have the United States dollar against Japanese yen. You can see all of them there. So these ones. So we have so many others. We have dollar index. Those ones, they are on the market. So you will find indices, currencies, commodities, all those ones, minerals there. You will find them there, and they are all traded. So those measures are only traded by beginners and the professionals alike. So the market doesn't know whether you are a beginner or what. It will favor you or disfavor you. So you have to begin while trading. Now we have the popular crosses like GBP stock, Japanese yen, and euro, and the Great Britain pound. Then, so those crosses are any currency pair that doesn't feature the USD and they do not hold any less profit potential than the majors. So too much USD dollar exposure can lead to all your trades heading in the same direction. So if you pick a trade with USD dollar, you pick another one with USD dollar, the effect will be the same. So if the base currency is USD dollar and it's strong, the market will go up. And if you pick another currency pair and you find the quote currency is the USD dollar, it will go down. So you'll find that it's like you are trading just the same pair, because if the market is going up and the other one is going down and you are picked those two trades with one common currency there, the effect will be the same but in opposite direction. So now we have the exotics now. You can see them, USD dollar against other currencies like those ones, USD against ZAR, that is the South African rand. Yes, now the exotics currency pairs are less traded and much more costly to buy or sell. Don't let the cost put you off, because many of the great traders of all time made their fortunes with exotics. So those professionals and the profitable traders, they use mostly exotic, yes. So because many of the greatest traders of all time made their profit with 14, for example, one of the 5 greatest forex traders, that is the George Soros, gained $800 million profit from selling Daibat, that is THB, in 1977 Asian crisis. So we had a crisis in 1997, and I'm sure many people benefited. So now we want to know how leverage works. So leverage in forex trading is all about borrowed capital in transaction. So the money is borrowed from a broker who acts like a bank. So the broker acts like a bank that fronts you some cash to invest, which in this case is to buy currencies. So that's the work of broker, of which I had explained earlier. So now with the leverage, for example, the leverage of 1 is to 20 or leverage of 1 is to 200. So with the margin trading ratio of 1 is to 20 options allows a trader who has invested, for example, $100 to trade with $2,000. Hope you understand that. So the change in leverage will affect your trade that way. So tips and warning when using leverage. So on this one you must be very keen. I mean extra keen. So keep your losses within manageable limits. So professional traders advise that one shouldn't risk all their money in the transaction. So beside traders reversing their risk by spreading it to about 5% of their total deposit. So in short, you have to trade with 5% of your deposit now. What you have in your account. For example, now let's say you have like $5,000. You should risk like 50 dollars. So it should be like 5%, or like let's say like 25, 10, 5. So that in case of volatility or in case of losses, you may not experience severe pain in that particular trade. So use stop loss orders and other strategies. So the stop loss orders sets your broker to know to sell a currency when it is a certain price. So now we use what we call stop loss. Stop loss will automatically stop your trade if it goes against your trade. So it stops you from making more losses. Then we have what we call what? Strategic stops. I think they are all the same. So always start slow at first. So this helps you building the novice trader's experience and confidence in the early days of trading. Once you have learned the ins and outs of forex trading, you can consider increasing the leverage. So the higher the leverage, the more the risk. So let us know when to trade forex. I think you are all following. So when the forex market is open 24 hours, that is like 24-hour economy, 5 days a week. This is not active during this entire time. So profits are made in forex trade when traders are bidding on the price and the market is active. So it is essential that you know the crucial time and days of forex trading when traders are the most active. So turnover now. You can see this chart now. This is what we call best time. For example, now you can see what we have what Sydney hours to trade Tokyo. Then we have the London, New York, So now you can see now, like in London now, you have the best time. Like what now? 18 hours. That's the best time. So the London switch is usually the most, and it is in the afternoon, overlaps with the opening of the New York All American session. So there can be good opportunities of forex trading, and you can make profit. So as a global market, forex spans multiple time zones. So we have different time frames. So it's like someone who is in Kenya like me, and someone else who is in America, we have different time frames. So now you may trade while at night. At the same time, in America, it will be a daytime. You trade during the daytime in Kenya, and in America, it will be at night. Hope you understand. So the busiest times are when these sessions overlap. So when many traders are in the market, like in Tokyo, it's just winding down. European traders are getting to the yard desks and analyze and digest information from the Asian trading session. So now, as you trade, the time you are trading, there are people who are also trading, or there are people who have already entered the market. So that is what we call overlapping. So the best time of the week to trade. So now, for example, now the best time is Tuesday and Wednesday. Why? Monday you analyze the market. Tuesday the market shows the trade line. But I'm not telling you not to trade in Monday. But what we consider is the best. We still have some good time, but we have good, better, and we have the best. So I'm not saying that you cannot trade on Monday. Monday may be good. It may also be better. But the best time is Tuesday and Wednesday. So research has found that the biggest movement in four of the major currency pairs, namely Euro USD, GBP USD, USD Japanese yen, and USD CHF, are observed on Tuesday and Wednesday. So these days generally show the biggest movement in currency as major data releases are related to the economy are usually released on this day. So Fridays are busy as well, but until 12 a.m. during the second time or Friday, movement can often be unpredictable since major banks, hedge funds, and financial institutions will cross same of the year positions for safety reasons over the weekend. So you have already known the best time to trade. So now the best trading hours are tailored for you. So when not to trade the forex market, bank holidays, like weekends, like when we have for example, like Christmas, those ones, Friday afternoons and weekends. Don't try to trade forex. Friday afternoons and weekends, you may make some huge losses. We have what? End of December. Now, like approaching Christmas. Then when angry or frustrated, so when you are frustrated, don't enter the market. Then you have Asian sessions, release of new events. Wait, in that time you may blow your account because the market is volatile. So market closing time, almost market closing time, don't trade overnight. Don't trade when you are sleepy. Yes, like such things. So now let's know what are bulls and bears in forex. So we use those two signs, bull and bears. So you think a currency will fall, then you sell the currency. So you open a short position. So you sell. So you are said to be bearish. So the first one is bearish. and you can also see the candle that is red. So bearish now, selling. That means selling. Or you think a currency will rise, so going upwards is what we call buying. So you open a long position. So when you buy, you are said to be bullish, and it is represented by the greenish bullish trade. You can also see the graph going downwards, going upwards. So we have what? Bearish, the green one, bullish. So now how to read charts in Forex. Line charts, these are the line charts. You can see the way it is. We have bar charts. So you can see the bar charts the way it is. Then you have candlestick charts. You can see the way candlestick chart it is. Then now we have what we call what? Regulated Forex brokers. You have to use the one which is regulated. Don't just use any. So you have now like what now? The broker that is called Etero broker. Capital.com is one of the good ones. We have XM Global and FX Pro, to mention a few. We still have others like XNS. They are all there. So now for optimum risk reward ratio is recommended to invest at least $300. So in Kenyan money that's about 4,000. So to 20 terms in brokers is quite a green rally or greenback. So decoding the most common terms used in Forex will speed up your understanding of the Forex. So now let's start here. We have what we call what? Currency nicknames. Single pair like euro, that are single. Loan name like what? The Canadian dollar. Swiss like the Swiss dollar. I think those ones you can understand, you can read at your own. Then you have popular phrases like what? Going long. That means opening a buying. All are bullish. Trade. Going short meaning what? Opening a selling. Rest all trade all bearish. Then cutting short to close a losing position. Then plugging. I price that singing all falling from its previous value. So that's where the market analysis is needed. So we have what some things to consider in the market. We have support and resistance. It is the above is what bearish financial. So we also have the buying or the bullish financial are the opposite of that one. So the double red strategy is a short term reversal term based on price action and the resistance. So the trade now is planned on a 5 minute chart and is signaled when the two bearish form lowing a test of resistance. So how to profit from this now, or how to make profit from this? Choose an asset and watch the market until you see the first red bar. So the red bar means what? Selling. The green one, buy. So those are the bars now. So like this one now, when you are selling, this is the what? The resistant level of, hope you understand what we mean by resistant. We said when the market was buying and starts selling. That is what we call resistant. So now let's continue. So how to identify trades in the market. This is what we call now the analysis of trade. So an upward trade is when the currency pair is increasing and it is characterized by high and high lows, like you can see here. The other one is the opposite, down trade. Then if a currency is in horizontal trade, it is also known as to ranging. So the market is flat. That is horizontal, it's flat. It's like it's flat. No much movement. It moves up, it goes back to the same position. Moves up, goes back to the same position. Hope you understand that. Then we have the strategies of forex trade. We have short-term trades, you trade a few hours. We have intermediate term trades, 2 to 3 weeks. Long-term trades, several months. Hope you understand that is common. So we have multiple time frames. So you can start charting currency pair on various time frames. So we have weekly charts, daily chart. That is what we mean by time frame. A minute chart. So now when we will come back to trading part, you will see the frames. I'll show you the frames, but not in this session. It's in the next video. So you have to subscribe to this channel so that you may see the next video when uploaded. So without consulting the weekly chart, you may have bought the currency and made a loss. So you have to check on charts. Then now you have the forex trading versus what commodities. You can see them. Oil versus USD card, gold, that way. Oh, there are so many. So now you have 10 tips from the pros. Now the people who know how to trade. Then start gradually. So it is advisable that you start trading with small amount. Then use stop loss. You must use stop loss when you are a beginner and when you have a small capital. So it is probably the most important advice that any forex trader pro who wishes when they started out, irrespective of your strategy, forgetting the stop loss order means that you haven't what limited your losses. So stop loss is for limiting your losses. Then we have what we call the 1/6 rule. Avoid the risk of getting caught in the trade and excitement. So overtrading has never been a good idea. So when you have profit, just quit the market. So stick to your strategy. Good traders have their own plan. Have your own plan. The best, make an effort to hold on it. Write your plan on a paper and follow it systematically. Write down the prices of each transaction and why you selected the particular strategy. Then do not what? Stop the profits. When it is advisable to get rid of greediness. Some beginners close their transaction too soon, else missing out the full profit. So patience in forex. So follow the trades. Don't just enter the market and you see this market might. No, just follow what you see. So trades indicate what is coming on the market. Simply that. So study the forex charts first before trading. Then trades have momentum. So trades tend to develop quick as the number of traders following them increase. So beginners should always be ready to identify when a trade starts and use it in their favor. Then always scrutinize your past trades. Check, just tend to develop quality as the number of traders following them increase. So beginners should always be ready to identify when a trade starts and use it to their favor. So close and successful position. So when you see you are making losses, just close the trade. So now I'd say that congratulations on reaching the end. So in the next video, I repeat, in the next video, we will do the practical part. So this was just the theoretical part. So now you can find my number. In the comment section. And if I fail to indicate it, just comment there. Put your number here. So that you may ask any question regarding forex trading. So in the next lesson, I will teach on practical parts of forex trading. Then after that, I will teach binary. I'll explain what is binary later in the next video. So make sure you subscribe for more. My name is Kenneth Wainaina Kituku. Thank you for watching and have a nice time. Bye bye.